Is the Ageas Federal Wealth Gain Insurance Plan truly a gateway to long-term wealth or just another ULIP with limited growth potential? Let us find out the answer to this question through an in-depth analysis in this video. Hi there, welcome back to holisticinvestment.in, where we help individual investors like you to make the right financial and investment decision to reach your financial goals in a more faster and smarter way. Now, before analyzing this policy, let us first understand a few basic details about it. This is a unit-linked, non-participating individual life insurance plan. Some of the key features of the policy are: you get to build wealth with the flexibility to pay premiums either monthly or annually, and you also get to protect your family with life cover and enjoy a waiver of future premiums in case of disability, and you also get to earn guaranteed loyalty additions that enhance your investment value, and you also get to choose investment options based on your risk appetite and switch between funds as needed, and you can also avail tax benefits. So these are some of the key features of the policy. Now let's take a look at the benefits. So there are maturity benefit, death benefit, and guaranteed additions available, and there are also investment strategies available and fund options according to your risk appetite and financial goals. You can choose these and invest accordingly. But as a unit link policy, there are also charges that we need to pay, like premium allocation charge, policy administration charge, mortality charges, fund management charge, and discontinuance charge. So these charges under the plan are considerably higher compared to other market linked investment options, because these high costs reduce your effective investable amount, directly impacting the growth of your corpus over time. So we need to consider this as a drawback. So some of the advantages are: your death benefit can be availed through a settlement option allowing flexible payout, and partial withdrawals are permitted from your policy investment account but only after the completion of the lock-in period, and guaranteed additions are also provided to further enhance your fund value. So these are some of the advantages. However, there are some disadvantages, like your funds remain locked for the first 5 policy years, limiting access. This plan does not provide an option to avail a loan against the policy, and the sum assured offered under this plan is also relatively inadequate. So these are some of the disadvantages that we need to keep in our mind before deciding to invest in this policy. So now, as we have a basic idea about this policy, let us move on to the analysis part of the video, where we are going to conduct an IRR analysis based on the benefit illustration given in the policy brochure to help us make a more informed decision. But if you want to know more about certain aspects of the policy in detail, you can refer to the policy brochure. So here, for example purpose, let us assume that a 35-year-old male has invested in this policy with a sum assured of 10 lakhs, a policy term of 20 years, and a premium payment term of 10 years, paying an annual premium of 1 lakh. At the end of the policy term, the accumulated fund value plus guaranteed additions are payable. So here in the policy brochure, they have projected returns at 4 and 8% per annum, just to show you how this policy can perform at worst and best case scenario. So these are not guaranteed returns, they are just for example purpose. The actual maturity benefit will depend on the future policy performance. At 4% return, the estimated fund value is 13.30 lakhs, and the IRR comes around 1.85% as per the policy maturity calculator. So this is for the worst case scenario. In the best case scenario, at 8% return, the estimated fund value is 24.46 lakhs, which is an IRR of 5.85% as per the policy's maturity calculator. So these returns are unimpressive for a long-term investment. For a market-linked product, such low IRRs offer limited wealth creation potential. Moreover, the sum assured is inadequate to meet a family's future financial goals, making it insufficient as a life insurance cover. So in summary, this policy fails to deliver on both fronts. It neither provides competitive returns nor offers adequate protection, rendering it ineffective as a comprehensive financial solution. So these are something that we need to keep in our mind, because the IRR analysis shows us that the returns from this policy fails to outpace inflation. So as this policy is not giving us a desirable outcome that we need, let us move on to a comparative analysis now, where we are going to take up an alternative approach in which we are going to separately invest in insurance and investment to see whether that can give us better and efficient returns compared to investing in a combined policy like Ageas policy. So for life cover purpose, we have taken up a pure term policy offering a sum assured of 10 lakhs, which cost us around 7,500 rupees per year for a 20-year term with a 10-year premium payment period. So in comparison, this policy requires an annual premium of 1 lakh. By choosing a term plan instead, you save 92,500 rupees each year, which can be invested separately for wealth creation. You can then select investment options based on your risk appetite. Here we have shown two scenarios, which one involves debt scenario, another one involves equity. So here, to align with PPF's 15-year minimum investment, contributions are adjusted in the final year. So the estimated maturity value is 27.29 lakhs. So the IRR comes around 6.58%. Even as a debt instrument, PPF generates a higher return than the 8% projection under the wealth gain plan, underscoring its efficiency for conservative miners. So if you have taken up the equity mutual fund route, assuming a 10-year investment period and long-term gains tax applied, your pre-tax maturity value comes around 56.46 lakhs and post-tax maturity value comes around 50.72 lakhs, and the post-tax IRR comes around 10.74%. These returns comfortably beat inflation and provide a strong wealth building potential over the long term. So if you want to know how we have calculated tax for equity mutual fund, you can see that we have presented a small tabular column on the screen for your easy reference, which you can pause and see. So this comparison clearly demonstrates that separating insurance and investment offers superior financial outcomes. Like a pure term policy ensures affordable financial protection, while dedicated investment in PPF or equity mutual fund helps you to achieve meaningful growth. So what is the final verdict then? Is investing in the Ageas Federal Wealth Gain Insurance Plan worth it or not? So this policy may sound promising by name, suggesting that it will help you achieve wealth gain. However, while the plan offers market-linked investment opportunities, a deeper analysis shows that its returns are lower compared to other market-linked options. The performance does not adequately justify the risk involved, primarily because of the high charges associated with the plan, and it also has a high agent commission. Furthermore, the sum assured offered is often insufficient to meet a family's essential financial needs, which can hinder long-term financial security. Even with the inclusion of guaranteed additions, the final fund value may not keep up with inflation, making it difficult to meet future financial goals. As a result, the plan is not well suited for long-term wealth creation. Combining life insurance and investment within a single product is rarely an effective strategy. A better approach is to opt for a pure term life insurance policy, which offers comprehensive protection for your family at a much lower cost. The investment component should be handled separately through a diversified portfolio of equity, debt, and other asset classes to efficiently pursue your financial goals.
You can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to our YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.